Have you ever looked at a company and just wondered, how do they do it? How do some businesses stay on top for decades while others just fizzle out? Well, the secret, a lot of the time, comes down to this one really powerful idea, the economic moat. It's like an invisible force field that separates the legends from the long forgotten. So let's get into it. Here's the game plan for this explainer. First, we're going to figure out what an economic moat actually is. Then we'll get into why it's so incredibly important for a company's survival. After that, we'll break down the 5 main ways companies build these defenses. Then, the fun part, how you can actually measure a moat. And finally, we'll look at what happens when those walls get breached.
To really wrap our heads around this, you've got to think less about balance sheets and more about, well, castles.
So, what on earth does a medieval castle have in common with a modern company? The answer is pretty much the key to this whole thing. It's all about a powerful, protective defense system. At its core, an economic moat is a durable competitive advantage. It's something that shields a company from rivals, just like a real moat filled with water protected a castle from invading armies. It keeps the competition out so the business inside can thrive without being under constant attack.
And hey, don't just take my word for it. This is a core idea for some of the world's greatest investors. Warren Buffett put it perfectly. The key isn't just having an advantage, it's about how long you can keep it. That durability, that's everything.
But how common are these things, really? You might be surprised. It turns out they are incredibly rare. Just look at this Morningstar data from 2024. Only about 17% of companies have what's called a wide moat. That's an advantage that's expected to last for 20 years or more. The rest, they have a narrow moat or no moat at all. That really tells you something. Building a truly powerful, lasting defense is unbelievably hard.
Okay, so we get what a moat is, and we know it's rare. But why does it make such a huge difference to a company's bottom line? Well, think about a company's stock price like this. It's made of 2 big pieces. First, you've got its steady state value, basically what the business is worth right now, as is. But a massive piece of its value comes from what we expect it to do in the future, all that growth. A strong moat is what protects that potential. It's the guardrails that ensure the company can actually deliver on that future promise without competitors swooping in and stealing it.
So if a moat is that important, how does a company actually go about building one? Where does this defensive power come from? Turns out there are 5 primary sources. Let's run through them. First up, network effects. This is the classic, the more people use it, the better it gets for everyone. Think social media. Then you have intangible assets. This is the powerful stuff you can't touch, like a patent on a breakthrough drug or a brand like Coca-Cola that people trust. Third is a cost advantage. This is when a company, maybe through massive scale like Walmart, can just do things cheaper than anyone else. Fourth, we have switching costs. This is when it's just a huge pain or super expensive for customers to leave. Think about trying to switch your company's entire cloud provider. And finally, there's efficient scale. This is for smaller markets, where it only makes sense to have 1 or 2 big players, like a local utility company.
All right, that all sounds great in theory, but how do you actually spot and measure a moat out in the wild? Well, you can think of it as a 2-step process. First, you survey the land around the castle, and then you go inspect the walls themselves.
So first, you analyze the industry. That's the land. A fantastic tool for this is Porter's 5 Forces. You're basically asking a bunch of questions. How easy is it for a new competitor to just show up and start selling? How much power do your customers have to drive down prices? What about your suppliers? Are there other different products that could do the same job? And finally, how vicious is the fight among the companies already there? If all those forces are really strong, it's like trying to build a castle in the middle of a battlefield.
So after you've scoped out the neighborhood, you have to look inside the company itself. You inspect the walls. This is where you analyze its value chain. You look at everything the company does, from how it gets its raw materials, to how it manufactures, to how it markets and sells. You're trying to pinpoint exactly where its advantage comes from. Is it a super efficient supply chain? A legendary brand? Nailing down these specific strengths tells you if the moat is deep and wide or just a shallow ditch.
But here's the thing. No castle, no matter how strong, is invincible. And in today's world, the ultimate siege weapon, the one thing that can make even the widest moats totally irrelevant, is disruptive innovation. Let's take a trip down memory lane with the ultimate cautionary tale. Back in the early 2000s, Blockbuster was an absolute giant, king of the castle. Their moat was this massive network of thousands of physical stores. It seemed totally untouchable. I mean, who could afford to build that? But then, along came Netflix. And they didn't try to storm Blockbuster's castle by building their own stores. Nope. They just changed the game entirely. First with those little red envelopes, DVDs by mail, no late fees, and then, of course, with streaming. They made Blockbuster's entire castle completely obsolete by offering something way, way more convenient.
The result, it was swift and it was brutal. By 2010, the seemingly invincible king of movie rentals was gone. Blockbuster filed for bankruptcy. Their moat, which was once so powerful, had been completely drained by a new technology they just couldn't get their heads around in time.
So why does this happen over and over again to big, smart companies? This chart explains it beautifully. You see, big companies are awesome at sustaining innovation, making their good products even better for their best customers. But that leaves them with a huge blind spot. They tend to run away from low-end disruption, cheaper, good enough alternatives, because the profit margins look terrible. And they're motivated to just completely ignore new market disruption, because it serves customers they don't even think about. By the time that little threat grows up, it's usually way too late.
So, let's wrap this up. What are the key things to remember? When you're trying to size up a company's moat, here are the core questions you have to ask yourself. How tough is it for someone new to enter this industry? How nasty is the fight between the current players? Does the company's brand actually make people willing to pay more? And maybe the most critical question today, is this company ready for the next big disruption, or are they just sitting around polishing the cannons on their old castle walls?
Which brings us to one final huge question. For a long time, the best moats could last for generations. But today, in an age of AI and lightning-fast technological change, we have to ask, are any moats truly safe anymore? Or is the pace of innovation now so fast that every single castle is permanently under siege? Now that's something to think about.